Welcome everyone to Klaas Financial's third quarter of 2021 webinar. We're excited to be with you here this afternoon. My name is CJ Klaas. I am the president here at Klaas Financial. To my right is Todd Eklund. He's the director of our portfolio management group. Few housekeeping items today. We're going to spend a little bit of time going through some slides. We expect the total time to take about 20 minutes of presentation, another 10 minutes or so of question and answer. It's actually a good reminder at the bottom of your screens, there's a little Q&A button that you can push on. And if you know what your questions are already, you can go ahead and submit them on the webinar now. Otherwise, at the very end, we will pause and wait for the Q&A roster to line up there. This is also being recorded, so when we are done with this, we will post this to our website. So if you do have to jump off early, you can always come back and listen to the rest of the content or share it with any of your friends and family. Remember, the intent of these webinars is for them to really educate you on the markets and the economy and to separate fact from fear. All too often, when you're listening to the news, it's really just about fear hyping. And our goal is to cut through a lot of that fear to give you the facts as we see them. Now, before we transition into the meat of our content, I do want to show you some facts about Klaas Financial, which is up here on the screen. So as you all know, we help our clients both plan and invest for retirement. As a matter of fact, this is our 45th year in business. We were founded back in 1976. By my father, Craig Klaas, and his brother, Palmer Klaas. I actually just saw both of them recently on a hunting fishing trip. And really, they began with the golden rule, which began the business with the golden rule. Treat others as you want to be treated. And at the end of the day, we're just trying to carry out that legacy that they built upon and even make it even greater. You'll also notice here on our screen that we have a map of the United States. It shows where our offices are located in Illinois and Wisconsin, but you can see those blue states represent all the states where we have clients who we work with. And most of you probably recognize this, but in the advent of Zoom and other technologies, the world has really flattened out. And so we are now really able to serve all across the United States. At this point, I'm going to transition it over to my partner, Todd.
Thanks, CJ. Well, thanks everyone for joining us again on our quarterly webinar. Before we dive into a discussion of the economy, I wanted to try something different this time. I wanted to start out with a poll question for you all about the economy. And if we can pull that up here, it's if it feels like so long from March 2020, right, when the pandemic first hit. Now we're still wearing masks depending on where you are. So some things have lingered around, but it really is a night and day difference between the depths of 2020. But I did want to ask the question to everyone. Do you think that in 2020 we experienced an economic recession? And we kept the choices simple here for you. Yes, it reminded me of 2008, or no, what are you talking about? So yes or no, we'll give you a couple seconds to filter those in, and we can share the results here. About 50-50.
This is great.
I thought it might look like this.
Yeah, this is great. It looks like there's a few more yet to vote. Keep going. All right, we'll go ahead and show the results.
So it's about split, but most of you, as I may perhaps expected, know what are you talking about? And we'll move ahead to the next slide here as we get into the economy. But I wanted to frame things up that way to really talk about where we are today, where we've been and where we are today. If we look at here on the slide in front of us, the shaded areas represent recession periods, and we're looking at unemployment. So this is the just percentage of Americans that are unemployed. Now, a recession, so those shaded areas, the definition of a recession is 2 consecutive quarters with negative GDP growth in the economy. So one of the things you can see as you look back to 2020, it was a very swift turnaround, right? The vaccine did not come out that quickly, but the cure for the economy seemed to come back that quickly. And here we are today, officially out from the recession. It doesn't even feel like we had one for many people out there. And yet you can still see the lingering signs that we did go through something very traumatic in this country for the impact that it's had both then and still lingering today. So unemployment today is, it's gotten better. You can see that rapid move down in that line, but it's still above the rate that you would expect, what they call sort of the long-term natural rate of unemployment that you should see when an economy is at full steam. So we're going to talk in a moment about the reasons for that, but we might be out of a recession, but the effects are still there. And I think that's been interesting to see that different people have experienced COVID and its effects in different ways. But on the other hand, we do want to say that we don't feel like we're on the precipice of another downturn. All signs do point to a fairly healthy economy, something that is not on the edge of tipping into oblivion. And the other thing we wanted to point out with this is that it's really hard to time these things as it relates to investing. So the decision to shift around because of what the economy is doing, there's a lot of reasons why we try and steer people from doing that, but sometimes these don't last long and you miss out. It's very hard to get that right.
Although, to highlight the answer to the question, did we experience a recession?
Yes.
The answer is yes.
Yes, and a deep one, and the deepest that we've ever had in this country by some measure.
So quick fact, recession is an economic term. It is not a stock market term. The reason many of you are wondering what we're talking about is because the stock market did dip in March of last year, but it came roaring back so quickly that you didn't think of it in terms of market. But a recession references the economy, which went through 2 consecutive quarters of negative GDP. So we did, in fact, hit a recession.
So if we move ahead to the next slide here, another unusual element or factor that is here today, and again, in the past, we really haven't seen this dynamic, is that in spite of having above average unemployment rates, there's more people out of work than would be the normal for this type of growing economy that we see today, right? Not in a recession. And yet we also have higher than average job openings out there. And so it'll be interesting to see what happens with this over time. I don't know the answer. We'll talk in a moment about some of the factors at play, but this is something that we would expect to not last forever. But you don't see this very often historically. So, as I said a moment ago, there probably isn't one single culprit to point to for this happening today, but we'll mention a few. COVID vaccination requirements. So many of you probably saw the headlines. I think it was 3 weeks, a month back. Certain businesses have required vaccinations, and notably, I think the airlines had tens of thousands of people laid off overnight one day last month. So that's a factor at play. You also have in some states welfare and unemployment benefits that, well, I'll tell you, I'm from California, and I do know that, there's people in California that the unemployment benefits extended during COVID. There are people making more money with the welfare unemployment benefits than they were working at their full-time job in many cases. So I don't know the extent to which that permeates the whole country, but there's certainly places in which that is more at play. And again, partly could be a factor in explaining this phenomenon. And then lastly, the skills and training mismatch. So I'll point to a couple examples. You have to look no farther than our profession in financial planning. There are more financial advisors out there retiring at a faster rate than we get people out of universities with a CFP to replenish. And that's just one place. But if you think of other industries in manufacturing, other jobs where there's a technology gap between the skills and knowledge that workers need to do a job and what people are equipped with at the time. So we'll see how these things play out. I think again, there's no one single culprit, but when you look at all of them in total, it's a pretty stark figure and something we'll be monitoring.
Yeah, to have the economy rebounding, the stock market rebounding, and to have unemployment this high is something we don't see often. Listen, I enjoy my Starbucks coffee, as do many people in our office, and it's hard to find Starbucks staying open beyond 2 o'clock in the afternoon, 4 o'clock in the afternoon. Granted, you're all wondering why I'm drinking coffee that late in the day. But the point of it is to say Starbucks actually pays quite well. Their benefits are quite rich for even part-time employees, and yet they can't find workers to keep their stores open. That's pretty unique.
And I just say this: there are some industries out there that are still stuck frozen from the pandemic. If you think events and conferences, for instance, now I think some of those things are coming back, but while a lot of things have been able to bounce back, there are still segments out there that, as this drags on to an extent, are still frozen with what that means for their people, their ability to grow and be back at normal times. So if we move ahead here, we're going to switch gears. We talked about the economy, but we want to go back to this topic that we spoke to last quarter, and it's still, a very hot button issue today, is inflation. And as you'll recall, inflation has been running much hotter than usual, much higher than usual in recent quarters. 5.4%. Now, just to put some context behind that, over the long run, over the last 20, 30 years, inflation tends to average about 2%. And that's sort of a number that policymakers tend to feel comfortable with. I think a lot of us in the planning profession have become comfortable with that as a figure, but 5.5%, that's a big leap. And so we do want to keep this top of mind for folks, particularly if you look here and you compare what is inflation year over year versus what is the return you get on a safe bond with a 10-year maturity, or in a money market account, or in your savings account at a bank. You can see that 0.1% on a 3-month certificate of deposit, next to nothing on a 10-year bond. So we've been saying this for a while, but this is really important, that understanding that investors can't stand on the sidelines today. And if you do, you are setting yourself back in real terms. You're not seeing it, but you're having your purchasing power, your ability to, fund what you need to do in your life over time, just erode away.
Let me make a few points here. What you're seeing on the screen, year over year inflation at 5.4, 10-year treasury at 1.4, and as you all experience, your bank accounts effectively at nothing. This is unique. To see real rates of return this negative doesn't happen all that often. You'll see short periods of time, but not typically
so far
periods.
Behind.
That's right. So you would call this a real rate of return. The real rate of return is negative on a 10-year bond. Think about that. You give your money to the government for 10 years and you are planning to lose 4% a year. In purchasing power. Again, you're not losing principal value, you're losing purchasing power. That's pretty unprecedented. But a few other factors that play into this. Number one, many of you should have received notice that if you're on Social Security, that Social Security actually did a cost of living adjustment of 5.9%, or they announced it starting for January of 2022. That is the largest increase I think we've seen since 1982.
Wow.
So huge increase in the cost of living adjustment on inflation. Now, most of you know, historically, that cost of living adjustment has more or less been washed out by also the increase of the Medicare Part B premium, but that is not projected to be the case this year. So inflation increase on your Social Security.
Did we come out ahead, in your opinion, on what we get with Social Security with the raise, or are we still...
Well,
we're getting next somewhere?
It's a good question. So we're not going to see it necessarily washed out on the Medicare Part B premium increase, but we're not going to. But what you will notice is that you'll need that to purchase goods and services. Okay. That'll be the issue, is things have gotten more expensive. A couple other points is just that bonds just at this point are not beating inflation. So you all should know, just because bonds aren't beating inflation doesn't mean you run from them. It just means that you recognize them as like the insurance policy in your portfolio. They are not the engine that's going to create the real return for you.
Yeah, and to add on to that, we always say, when we ask, should I be in the market or out of the market? It is about being in both and being disciplined over time. So in saying this, we don't want to say don't own any bonds, but to sit on the sidelines and take no risk is to keep moving backwards with your money over time today.
And the final comment I'll make about this as it relates to inflation is that how much inflation impacts you is not equal by every household.
Yeah, and we're going to cover that here in a moment. But
we are, yes. So effectively, you need to realize that if you have income sources in retirement like Social Security or a pension through the state of Wisconsin, those are actually inflation adjusted annually. And so it will keep up your purchasing power. However, if you don't have good income sources like that, you could find that you do fall behind according to inflation. So at the end of the day, understand that inflation is back, but it doesn't impact all households equally.
So let's move ahead and take a look at that with a bit more detail. There's this big question: is this inflation here to stay? Right? It's almost 5.5%. But are we going to be stuck there? Do I need to worry that we're in a new era where that's going to be what inflation runs at year after year after year? The answer is too soon to tell, and probably not ready to make that diagnosis quite yet. There's a couple of things that usually underpin sustained inflation. The first would be very loose credit and lending standards, where money is being doled out. If you think back to 2007 with they called it NINJA, no job, no income loans for homes and things like that. Certainly, people can get loans today for what they need, but we're far from the excesses, in my opinion, that we've seen during some periods in the past. And then there's also, the labor market conditions of just full employment. Typically a really strong economy with, not lots of job openings, right? A very tight labor market has tended to bring about, higher inflation that was sustained. And then, thinking back to the 70s, shocks from oil prices, instability in, key commodities. I don't want to opine on what that could look like forever, but I think it's certainly today that those risks aren't quite as pervasive as they were back 40, 50 years ago.
Well, and so actually we have a question. I don't know if you all can see it, but we can. It was, how is it that year over year inflation number is calculated? We are seeing costs of raw materials and freight rise by well over that 5.4% number. And as a matter of fact, this slide hits it.
Yes.
So what you are seeing on this slide is the last 10 years, the average rate of inflation over that time frame was 22.1% cumulatively, or 1.8% on average. That's that gray line.
Call it 2%.
Call it 2%. But you'll notice that certain segments of the economy, hospital services, beef and veal, college costs, or now more recently, lumber costs,
went up quite a bit and consistently.
That's right. So when you're looking at inflation, you actually have to look at the definition of what inflation is. A core CPI. What is it that they're actually looking at in the inflation number? Some inflation figures actually strip out some of the more volatile sectors. We actually talked about this in last quarter. We went into detail on how that gets defined, but it's not uncommon to have segments that spike well beyond the average rate of inflation.
And going back to CJ's point, that what's important, I think, to think about on this slide is that each of these things affects each and every one of us quite differently. And so, for instance, somebody who's 40 years old is not going to be quite as worried about hospital services and managed care going up at 60% over the next 5, 7, 10 years. On the other hand, though, someone who's 40 years old, has 4 daughters, and they are all dead set on going to a liberal arts college in New Hampshire, they're going to be really concerned about college tuition going up. CJ, I think you've got 2 daughters nearing the end of high school and a growing young boy who probably likes beef and veal, so you might be sweating it a little bit. But the point is that these things do need to be considered for each of us with where we are in our life cycle and how they might affect us.
There's no doubt. Let me to kind of poignantly move towards this. If you have young kids going to college like I will someday, these numbers are something you need to be aware of. But if you're a college professor, the way you interpret those numbers is differently. Let me use another example. You may not like that one. If you're a parent in a long-term care facility, it might impact your finances differently than if you're a developer of senior housing and long-term care facilities. Yeah. You see the point? That the inflation numbers that spike on the one end may impact negatively one sector of society and may positively impact the other. And here would be the final example I would give to you. If you are building a home right now, my hat's off to you. Good luck. It's pretty expensive. But if you live in a home right now that's already been built, the price of that home has inflated since the cost of the goods has helped you. Yeah. So again, these we look at the things tend to have this jaded perspective on anything that impacts us negatively, but somebody is benefiting from that.
And again, going back to, we try and focus on the things of where you are at in your life cycle and really be pragmatic about these and stress test them, right? And we can look at them differently to help you course correct.
Yeah. There are a couple of questions. Listen, we're actually going off script a little bit here. Typically we wait till the end, but since these are all about inflation, I don't want to miss the opportunity. So one of the questions is, how do we combat both high inflation and risks? Or I'm sorry, our government has stated that inflation will decrease relatively soon. What are your thoughts? We don't know. We actually don't try to make bets on exactly what inflation will be year over year. However, we're going to be talking about this in just a little bit. We do think that this inflation spike, at least where we've jumped to this 5+% number, is driven somewhat by a supply chain disruption. We could see that absolutely kind of normalizing a bit over time. But we don't make bets at this. We don't know what will happen year to year.
If the government's worried about it, they can just keep tacking up that Social Security increase for us, right? So
yes, that's right. Go ahead.
So we'll move along here, and we're going to talk about inflation some more. I think we've got some great demonstrations CJ is going to talk through, but we really want people to understand what this means for you.
Exactly. Yeah. So what you're seeing on your screens here is, again, continuing with this theme of inflation. And I know this is top of mind for a lot of you. We're looking at the loss of purchasing power over time due to inflation on $1,000. And this is over a 25-year time frame from 1995 to 2020. On the left there, you can see the green bar that shows 1995 cash of $1,000, and then what happened 20 years later to the real purchasing power, or kind of the net of inflation adjustment of that. And if you literally just took that $1,000, put it under your mattress, pulled that $1,000 out 25 years later, it had dropped in purchasing power, not in dollars, because it's the same money. It had dropped in purchasing power almost, or I should say over 40%, almost half. That's a big deal. What it should stimulate you to think about is, how am I addressing the risk of inflation across my portfolio?
And by the way, this is not the 1970s we're talking about here. This is a pretty good period of time that things were pretty under control with inflation. There wasn't oil shocks and lines for gasoline that some of you may remember at different periods in time back.
That's right. During the Reagan administration era, many of you remember probably purchasing your first homes, the mortgages that you had at that time. My bet is many of you had a mortgage between 12 and 16%. But that time frame of 1995 to 2020 is actually not that high inflation time frame. That was more of a normalized rate. Now, what we see here on the screen now is purchasing power over time due to inflation. This whole trend continued. But now what we say is, what if instead of having, we'll just say, all of your money sitting in cash,
or in the mattress,
thank you, under the mattress, what would happen in real terms if I just had it in a 60% global stock, 40% bond portfolio?
It balanced it.
It balanced it. So we're not talking aggressive here. We're not talking conservative. This is really a moderate investor. And my comment to you all would be, let this sink in. You would have gone from cutting your purchasing power in half in the case of cash to literally tripling,
6-7-fold or something.
It's incredible, the differential of having money invested. And it's really what the equity markets provide for us.
And this is hard to think about along the way. It's hard to keep this top of mind when the coronavirus hits and you see,
that's right,
a drop, not just in percentage terms, but in real dollars that you've worked hard for.
That's
drop
right.
very quickly. But this is something that we really try and emphasize, that it is really about keeping the long view. And if you can, it is very well rewarded for what it'll do for you.
That's right. Yep. Yeah. So hopefully this is impactful. Again, does this mean that you should not have money in cash or emergency reserves? And anybody who knows our firm, the answer would be, of course not. You should have your emergencies. You certainly should have cash. Within your cash, you should be trying to get the best yield that you can. So this is not a knock on cash as much as it is an emphasis that if you want to see real net of inflation rates of return, you're going to have to get the engine of equities working for you. Now, as we move forward, we're going to take a look at impacts of potential tax legislation changes. So we wanted to spend part of our time today talking about inflation. That's been a real risk we saw pop up over the last year.
That's the silent thing you'll take from your pocket.
That's right. It's the silent killer. But the less silent killer, what you're seeing in the media right now, are all about potential tax changes. Now, I want to couch this discussion. There are actually two pieces of legislation that the Biden-Harris administration proposed. The first part was an infrastructure and jobs spending bill that was about $1.2 trillion that did already pass the Senate and is right now being evaluated by the House of Representatives. There's a second part to it that is the Build Back Better Act. That's what they're calling it right now, at least. That is a $3.5 trillion spending bill, and it really includes social and educational reforms. It is that $3.5 trillion piece that we're going to talk about, and that is what includes some of the tax changes. But I will let you know that this is not a comprehensive list. As a matter of fact, this is a really small list of the proposed tax changes. And we're also not talking about the benefits of the bill. So I don't want people to think we're being political here. We're not trying to talk about the negative implications instead of the positive. Rather, as you can all imagine, being in our profession, we need to be aware of how any tax changes to pay for the benefits, how it would impact you.
What are the levers that can be pulled?
That's right.
There's all this spending that wants and needs, but okay, what are the ways that we can approach it? And then with each area, what does that actually mean for you?
That's right. So there's a lot of things that are not on this list. There's things like a reduction of the federal estate tax. There's things like potentially elimination of a step up in basis upon death. A lot of these things are still being kicked around right now as we speak. And even what we show here on the screen is still being evaluated, but we wanted to kind of highlight 4 of them. So the first being corporate taxes, as you can see here. The current rate is right around 21%. Biden's proposal was 28%, and the House tax proposal is coming in at 26.5. Most of you listening on here are not a corporation who will pay this, but some of you may represent corporations that could be impacted by this, and this could mean changes in the way that you handle cash and income.
It was almost 50 back at one point, 34 years ago.
That's right. Yep. The next component was a surplus tax for really high income earners. And as you can see, that surplus tax was not is not included right now. It was not originally included in the Biden tax proposal. And however, it is being included in the House tax proposal for people earning over 5 million a year. It would just be an extra tax to help to pay for all of this additional spending. But the areas we really want to raise your attention to that could impact more of the individuals or families listening today would be in the capital gains and the individual income tax brackets. As you can see right now, the top bracket for capital gains is 20% for individuals earning over $445,000. But that has been proposed to be moved up back to where it used to be.
And almost doubling, with the original proposal, right? In terms of the percentage.
That's right. That's exactly right. And thank you for correcting me. No, actually, it's not going back to where it used to be. That is an almost doubling for families earning over $1 million a year, that it would go from a separate capital gains tax rate to actually matching your federal marginal income taxes. Now, that's being knocked around right now. It looks like it might come in somewhere closer to 25%.
But pretty sanguine compared to
the
original.
That's exactly right. Similarly, individual income tax rates, top bracket right now for marginal federal income taxes is 37% for households over individuals over 523 in income. Biden-Harris had proposed moving it up to 39.6, which is going back to what it used to be for individuals over 450. And then finally, what they're looking at right now in the House is actually for individuals over 400,000. I'll be frank, Todd and I talked a lot about whether or not we even review this slide. The reason being because this is all conjecture.
Yes.
We don't know. However, what we would say are the following summaries. Inflation is real. It is impacting the purchasing power of your dollars. You need to decide how you will address that, if you will address that, if there's any changes you need to make as a byproduct. The second piece is that there are changes coming. And you need to understand the thematic components of those tax changes to understand, again, thematically, if it would impact you. Here might be an example. If I was an individual with super high income, with a stock that had a lot of capital appreciation inside of it right now, I might be considering trying to do a 2021 sale of that if my goal was to eventually diversify, because the markets are high and because I know what the capital gains tax rate is for this year. I don't know what it'll be for future years. So there are actual implications for understanding how these potential changes might impact you. But all I can really encourage you to do is, this is why you need to meet with your financial advisor to determine.
And the last thing I say is, for a lot of folks that as you are near or are move into retirement, some of these things that you might hear, there's such a big concern, they probably wouldn't impact you. If people move into retirement, their income drops, you really wouldn't be affected by some of these increases in the same way. And so really to just stay grounded in that, and almost inflation is what you should worry. We don't want you to worry from these things, but you should be more worried about inflation than anything that Democrats or Biden are proposing for taxes generally as a retiree.
Right.
I can't extrapolate that forever, but
no, Todd brings up a great point. For most of you listening to us right now, probably upwards of 95%. The proposed tax hikes that you're seeing on your screen here, at least as they're proposed now, won't impact you significantly, if at all. However, for those that it does impact, I also empathize. I don't want you to feel that we're dismissing that. I understand that you're already paying a lot of tax, and the idea of paying more may be frustrating to you. But again, we would just encourage you, remain calm, talk to your advisor about any tweaks you might want to make. And really in the background, we think we have an overall healthy economy that's recovering.
We got a good question, if I could jump into it.
Yeah,
start that up here. We have a question that filtered in. Of these 4 taxes discussed, which, if any, are likely to harm the economy long term? And we'll maybe both take a crack at that.
Go ahead.
You could argue any of them in different ways, but I think importantly, the corporate tax and the capital gains tax are both important. Corporate tax, because it affects what corporations do to invest for the future, to create more opportunity, to keep the engine of the economy growing. And so, for instance, if it becomes, if the incentives change such that there's no incentive to take risk, invest that money back in, and to take it all out as income, that's very detrimental for the economy recovering, for us reskilling in those jobs or the workforce, doing some of those things that get us future ready to sustain this growth. If I'd say which one will least affect the future of the economy, it'd be things like that surplus income tax. Now, if you're a very high earner, I don't want to offend you. There's people out there that work in hedge funds and private equity, and there's a tax called carried interest, which is often targeted. So there's areas that for the very, very, very highest earners in society, they look to try and get a little bit more of that as tax revenue. And in my opinion, I think over the long term, something like that poses the least risk to the health of the economy going forward.
I would echo 100% what Todd just said. To reiterate, the corporate tax rate of all of them has the greatest potential for impacting the kind of rate of growth in the United States. These other ones, if you look at them statistically and the percentage of the population that it'll impact, it's such a small percentage that it probably won't impact the momentum of the economy. But corporate taxes, on the other hand, can have a big impact. Now, some of you are thinking, but they can shift the monies offshore and there's repatriation rules, and we get that. But anybody who runs a corporation knows that there's only so much you can do before these higher corporate tax rates have an impact on you.
Here's another great question. Will inflation increase or keep moving up if the government passes this larger 3.5 trillion bill? And I think what I would say is, if you think back, the package is for the infrastructure, right?
Yeah.
And so this idea that we're going to spend a lot of money on the infrastructure of the country, create jobs, but that probably is, other things equal, inflationary. I do question, though, I think that, for any of you that have driven around some roads and bridges, gone on a road trip in this country, there are a lot of areas that could use, an overhaul. And this idea of, is it inflationary, but is it going to keep inflation high like the 1970s? I think that's to be determined. But in my opinion, an infrastructure bill and the spending on it is something that is not a high risk of excessiveness, right? The evidence wouldn't suggest that is something that is going to keep inflation high forever and necessarily be a bad thing, in my view.
Well, and to clarify, so it was the $1.2 trillion bill that was the infrastructure bill. And I would echo what Todd said. Part of the reason that a president will do that is because it's fairly bipartisan. As a matter of fact, that did pass with bipartisan support. It's the next component part, which is the Build Back Better. It includes the social and education reforms. That is the piece that's going to have a bigger struggle, and that piece, as Todd has admitted, could be inflationary. Now, again, in all of this, it's There's an academic part to this where you look at other countries that have actually overprinted or overspent. And it doesn't always turn out the way that you would think. We all think to ourselves, more dollars chasing the same goods and services is by definition inflationary.
Zimbabwe had like 1,000% inflation in a three-month period.
And yet you look at Japan, and actually they have a debt problem, but haven't had inflation. Now they've had deflation, which is an even bigger problem. So there's no doubt that you have to be aware of how any president plans to pay for these things. That is a big component, because at the end of the day, I don't mind spending that gets offset with some sort of kind of budget reconciliation. But where we're just continuing to tack on more and more debt without any way of reconciling it in the long run could be a problem for the United States. But again, these are very difficult things to project. We've never had the world superpower printing this much money. And what does it really do 10, 15, 20 years from now? My encouragement to you would be, it would be dangerous to try to predict. You can find a lot of opinions on this, but
Sure.
The danger is trying to be predictive.
I think we always try and think through what could happen in stress tests. It's one of the things that we look at with your financial plan. Assuming things will remain exactly like they are would be dangerous, and making a wild crystal ball forecast of how you plan for some scenario that looks different that you are so sure will happen is also just as dangerous.
Yes. So we want to end at least the presentation part of this with this quote. Many of you have probably heard it. We cannot control the wind, but we can direct the sails. So I'm going to have a little fun here at the end of our presentation. Everybody, please play along with me. I want you all to close your eyes and envision two sailboat captains heading towards an island in the middle of a choppy sea with a storm rolling in. Okay, envision this, two of them. One captain is yelling at the wind and waves, spending all of his energy negotiating with the wind. The other captain is adjusting his sail and navigating around the storm in order to get to the island. So here's a couple of questions. How much control do you have over the wind and the waves? The second question, what boat captain would you like to join? And finally, here's the statement I'll leave you with. We are the boat captain adjusting the sail of your financial plans to navigate around the storm in order to help you reach an ideal retirement. So there's only so much yelling at the wind. Call it the yelling at politicians, the yelling at tax hikes, the yelling at what's happening. And don't mishear me. I'm not trying to say that those things don't matter. But in our world, there's only so much yelling you can do before you pause and say, hey, let's just adjust the sails of our clients' financial plans to accommodate whatever is happening so that we can just continue to help them reach their financial goal. We would encourage you to view a lot of these proposed changes through that lens, because if you all can empathize with me, there's only so much help in listening to the media and getting hyped up and getting all stressed at the end of the day. Sometimes it just requires us to kind of turn it off and determine how we're going to adjust our sails.
And we want to be here to help you make those choices, understand them, evaluate them, and get there safely.
That's right. So at this point, that's the end of our presentation section, but we do want to open it up to questions.
We did a few.
We did a few.
I think I only see one last one that we didn't answer, but it's a good one maybe to end with, as we suggest staying calm and have that as our ending message. A question about how do we combat both high inflation and the risk of a market crash? And maybe to frame that up, a scenario like the 1970s of really high inflation and not a good stock market.
Yep.
CJ,
boy,
how do you deal with that?
This is the challenge. Our human nature is extreme by definition. It's the reason why we have such polarized politics here in the United States. I know we like to blame Congress, but truth be told, we all contribute to that polarization. And we see it in financial planning. People either come in and they want to be all in the stock market, or they want to be all out of the stock market. It's just human nature to have these extreme polarizing views. And that's the way that I would answer this question. How do we combat both high inflation, which of course can be difficult for bonds to keep up with, right? While also a stock market crash, which can be detrimental to a stock? And the answer is actually own a little of both. I know that might seem trite. I know it might seem oversimplified, but actually, when you empirically evaluate the longest term successful investors, it is those that know their time frame. They know their risk tolerance, and they stick with their asset allocation and financial plan, regardless of the wind and the waves.
They talk about the 1970s as the lost decade for investing. But if you think for many of us, we have many decades, even if you're approaching retirement. And so one that is more difficult or has a storm to it is not your final destination.
Yep, absolutely. Such a great question. Thank you for asking it. Listen, at this point, that concludes our time. I've got a timer here. I can see that we're at 40 minutes, so our apologies for going a little bit long today, but thank you so much for participating. What great questions you all asked. Todd and I really enjoy doing these. We will be back here again next quarter, which would be in early January, to wrap up the 2021 year. Until then, we hope your family has a wonderful holiday season. Stay blessed, stay safe, and we'll look forward to seeing you in another quarter.
See you soon, everyone.
Bye-bye.